Do you want to turn your dividends into a steady paycheck every week instead of waiting for that monthly payout? Imagine getting paid weekly while tapping into the power of the S&P 500 and the NASDAQ 100, two of the strongest indexes in the world. It sounds like a dream for income investors, right? But with XDTE and QDTE, two revolutionary ETFs, it's now a reality. In today's video, we're breaking down how these new ETFs from Roundhill Investments are flipping the script on dividend income. Stick around, because this could be the game-changing strategy your portfolio needs. Before we dive into the details of XDTE and QDTE, let's quickly talk about the strategy behind these innovative ETFs. At the core of both of these funds is a covered call strategy, one of the most popular ways to generate consistent income from an investment. But Roundhill Investments is taking it a step further by offering weekly payouts, something you don't see every day in the world of ETFs. For those who aren't familiar with Roundhill, they've been making waves in the investment world since 2018, focusing on cutting-edge financial products designed to help investors tap into niche markets and unique strategies. Now Roundhill is pushing the boundaries again with XDTE and QDTE. These ETFs don't just hold stocks. They use a synthetic covered call strategy to generate income, and instead of waiting a full month for your distribution, you get paid weekly. This is a game changer for investors looking to smooth out cash flow and maximize their income potential. Whether you're invested in the S&P 500 or the tech-heavy NASDAQ 100, Roundhill is making sure you don't have to wait to see returns from your investments. But before we dive into further details, do me a huge favor. Hit that like button, subscribe to the channel, and let's build our financial future together. Now let's dive into XDTE, an ETF designed to give you exposure to the powerhouse of the S&P 500 with one huge twist. Instead of getting paid monthly or quarterly, you're paid weekly. XDTE is not your typical ETF that holds stocks. It's built around a synthetic covered call strategy that uses options to generate income. And the numbers are impressive. First off, XDTE currently manages about $159 million in assets, with a market price of $52 per share. What's really exciting about this ETF is its incredible dividend yield. XDTE offers a massive yield of 13.34%. That's right, 13%. Over the past year, it has paid out a total of $7.03 per share. And remember, you don't have to wait a month or a quarter for that cash. With XDTE, you get a slice of that payout every single week, giving you a steady, reliable income stream. For income investors, this can be a game changer. But how does it actually generate that income? Let's break it down. Instead of holding actual S&P 500 stocks, XDTE holds long, deep-in-the-money call options on the S&P 500 index. These options give the fund exposure to the price movements of the S&P 500 without directly owning the stocks. Then, every day, XDTE sells short-term 0 days to expiry (DTE) call options that expire the same day they're sold. The ETF collects a premium from these options, which is how it generates the income it pays out to investors. This strategy works beautifully in a rising market. As the S&P 500 moves up, XDTE benefits from the price increase while also collecting those daily option premiums. That's why you're seeing such a strong dividend yield and weekly distributions. Plus, the expense ratio is 0.95%, which, while higher than some traditional ETFs, is fairly typical for more advanced strategies like this. Now let's talk about risks. Like any covered call strategy, XDTE's income generation is balanced by the potential for something called NAV erosion. This happens when the short call options end up in the money during volatile markets, and XDTE could lose money on its option positions. So, while the fund is designed to pay you every week, there's a chance the underlying value of the ETF could drop during volatile periods. With only 3 total holdings, XDTE is highly focused on executing its option strategy. And so far, the results speak for themselves. The strong dividend yield shows this ETF is focused on delivering consistent payouts. So what's the takeaway? XDTE is perfect for income investors who want more frequent payouts and are willing to accept the trade-offs of an options-driven strategy. You get the power of the S&P 500 combined with a steady flow of weekly income, making it a unique addition to any portfolio looking for cash flow. But like with any investment, understanding the risks and rewards is key. Let's now dive into QDTE, an ETF that gives you the chance to tap into the explosive growth of the NASDAQ 100 while getting paid weekly. Yes, you heard that right. Weekly payouts from some of the biggest tech companies in the world, all without owning a single stock. This ETF uses a synthetic covered call strategy, just like XDTE, but with the high growth potential of the NASDAQ 100 at its core. Here's where it gets really exciting. QDTE manages $447 million in assets and trades at a market price of $42 per share. Now, if you're an income-focused investor, the numbers here are going to catch your attention. QDTE boasts an incredible dividend yield of 21.03%. Over the past year, it's paid out $9.05 per share, and the best part is you get these payments every single week. This isn't your average ETF. QDTE is built to provide consistent, high-yield payouts, making it an attractive option for anyone looking to generate steady cash flow. So, how does QDTE generate such impressive income? It all starts with the long, deep in-the-money call options on the NASDAQ 100 NDX index, which give the fund exposure to the price movements of the NASDAQ 100. Then, every day, QDTE sells 0 days to expiry (DTE) call options just slightly out of the money. These options expire the same day they're sold, allowing the ETF to collect daily premiums, which are then distributed to investors weekly. Why does this matter? The NASDAQ 100 is known for its high volatility. Tech stocks like Apple, Amazon, and Microsoft tend to have big price swings. This volatility can actually work in QDTE's favor, helping generate larger option premiums and potentially boosting returns. So, while XDTE gives you exposure to the more stable S&P 500, QDTE is designed for investors who want to capture the tech sector's growth potential while still receiving a consistent weekly payout. Now let's talk about the potential risks. Like XDTE, QDTE's strategy can lead to NAV erosion in volatile markets, especially if the daily short call options end up in the money. This means that in certain market conditions, QDTE may lose out on some income if the NASDAQ 100 makes unexpected big moves. But that's the trade-off with a high-income, options-driven strategy. You limit some upside to create a steady income stream. QDTE has an expense ratio of 0.95%, which is typical for covered call strategies that require daily option selling. While the fee is higher than some traditional ETFs, the 21.03% dividend yield and the benefit of weekly payouts make it a compelling choice for income-focused investors who don't mind a bit of volatility. And with just 3 total holdings, this ETF is laser-focused on executing its strategy efficiently. So why might QDTE be the right fit for your portfolio? If you're bullish on the NASDAQ 100 and you like the idea of turning that volatility into a steady weekly income stream, QDTE could be a game-changer for your investment strategy. The combination of high-growth tech exposure and weekly payouts gives you the best of both worlds: capital appreciation potential and consistent income. So, what's the future looking like for these innovative weekly payout ETFs, XDTE and QDTE? With markets becoming more unpredictable, investors are constantly looking for ways to generate consistent income while managing risk. This is where both of these ETFs stand out. The idea of getting paid every single week is a game changer, especially in times of market volatility where cash flow becomes a priority for many investors. XDTE, with its exposure to the S&P 500, offers stability and reliable income, making it ideal for those who prefer the broad, diversified market. Meanwhile, QDTE's focus on the NASDAQ 100 provides a more aggressive option for those looking to capitalize on the growth potential of the tech sector. As we head into 2025, there are a few things to keep in mind. First, if the market remains bullish, both of these ETFs could continue to generate strong returns while delivering those consistent weekly payouts. In a rising market, XDTE and QDTE will benefit from the price movements of their respective indexes And as long as the demand for options remains high, they'll keep collecting those daily premiums. However, if volatility increases, especially in the tech-heavy NASDAQ 100, QDTE's strategy could face more challenges with NAV erosion, making it more susceptible to downside risks. For income-focused investors, the concept of weekly payouts is extremely appealing. But it's important to remember that this doesn't come without trade-offs. The higher the potential yield, the more volatility you're likely to experience. That being said, both XDTE and QDTE have proven themselves as reliable income generators, especially for those willing to accept the risks that come with options-based strategies. So, where do XDTE and QDTE fit into your portfolio? If you're someone who values steady, frequent payouts and wants to leverage market exposure without directly holding individual stocks, these ETFs could be a smart addition. XDTE is great for those seeking stability with the S&P 500, while QDTE is tailored for more aggressive investors who believe in the long-term growth of the NASDAQ 100 and are willing to ride out some volatility in exchange for potentially higher returns. As always, the key is balance. You may want to consider blending XDTE and QDTE with other assets in your portfolio to create a diversified strategy that aligns with your risk tolerance and income needs. Whether you're using these ETFs for weekly income in retirement or as a complement to your growth-focused portfolio, they offer a unique way to capture income from two of the most influential indexes in the world. So, what do you think? Are XDTE and QDTE the right ETFs for your portfolio? Let me know in the comments below. And don't forget, if you found this video helpful, make sure to hit the like button, subscribe, and share it with your fellow investors. Thanks for watching, and I'll see you in the next video.